Good evening, everyone. Happy Thursday. Welcome to our first class for July. This is our credit scores and reports class. If you are here tonight and you're attending your very first class with Dallas Habitat, give us a shout in the chat box. We want to hear from you if this is your first webinar with us. We know we've got a bunch of brand new clients that we're working with, and this might be the first time that you're joining. We'd love to know that. To all of our attendees tonight, whether you're new or you're returning, welcome. My name is Blaine Cower. I am the Senior Director of Homeowner Services here at Dallas Habitat. And we have our amazing counseling team here with us tonight as well. Behind the scenes, Aretha Higgins and Porfirio Coronado. So if you are in our counseling program, your counselors are here supporting you as well. And we're so excited for tonight's content because quite honestly, this is one of the most popular topics when it comes to classes, and really one of the most important topics when it comes to preparing for homeownership, and that is credit. There are so many myths, as we know, that exist about credit out there. And we get so many questions and concerns about clients coming through our program about whether our credit is where it needs to be, what credit score is considered a good credit score, and how we can strategize to really get into the range that we need to get a mortgage approval. So we're going to talk about those things tonight. And to dive into this topic, we are so excited to bring on the experts, our partners at Comerica Bank. And if you've been on our webinars, you've seen Comerica here a couple of times over the last few months. They are wonderful partners. And I'm so excited to introduce you all to our expert presenter tonight. His name is Trent Sampson. Welcome, Trent.
Good afternoon, everyone.
Good afternoon. Trent, I'm going to turn it over to you if you'd like to introduce yourself to the audience, and then you can take it away.
Well, thank you very much, Blaine. Good afternoon, everyone. My name is Trent Sampson. I am a relationship manager here at Comerica, and my responsibilities here, I work with small and mid-sized companies, and primarily my role with them is I provide credit facilities for them, and I handle depository, treasury management, international, and other type of auxiliary banking services that we do with respect to our clients. My clients are typically in the space, probably about somewhere between, from a borrowing standpoint, about 500,000 on up to maybe about $5 to $10 million. So I have some clients that are, just across various different loan amounts in various sectors. And those sectors include primarily manufacturing, wholesaling, distributors. And what we tend to focus on is just people who run and operate their own business. That's been our focus over here. Daily, on a day-to-day basis, some of the tools that I use are what we consider the 5 C's of credit. And I don't know if you guys heard too much about the 5 C's of credit. 5 C's of credit primarily is just metrics that banks will use to evaluate clients when they come into the door for a commercial loan. And those 5 C's consist of capacity, that's how much you're able to borrow, cash flow, how strong the repayment is, credit, conditions, and character. And so what we're probably going to look at today is we're going to look at character, and with character comes into effect your credit score and also cash flow, because cash flow tells us, how well you can repay us. So with that said, I'm going to just go ahead and just dive into the presentation of our presentation this evening, which is credit scores and reports. In this particular workshop, what we kind of want to focus on is just, as Blaine indicated, just how important your credit score and reports are, how to access information about your credit report, discuss some strategies to build and improve your credit, and what kind of methods can we use to protect your credit from incorrect information and claims. What is a credit score? A credit score is a 3-digit number that just tells us your ability to repay. From a risk perspective, this is just a good indicator to tell the lenders how well you're going to repay your obligation. And so lenders really look at this because they can look at these particular numbers here and just gauge. And depending on where you flare between less than 579 and the upwards of 800, that will tell the lender how well you've handled your obligations in the past. And for us, that's a good indication for lenders because that tells us, we're going to get repaid. There are two things that lenders really on the front end that we're really concerned about. Number one, we're concerned about loaning money to the wrong people. And number two, loaning money to the right people. And so you want to always just make sure you're in that second category because one of the criteria that we do use is how well you've paid your obligations in the past. And your credit score is just a good indication of those metrics, and that'll tell us how well you've handled all of your past bills, your expenditures, any debt obligation that's reported to the agency. Well, how do you build your credit score? There are a couple of ways that you can build your credit score. One is really just to open up a line of credit, and generally that can be a line of credit at with a credit card. For example, you may have let's just say you have a line of credit with Dillard's. So Dillard's may say, okay, we'll give you a credit card and your limit will be $1,000. And so that's an open line of credit. Another manner to build your credit is just request that your payment history be reported, open up a joint account, and some joint accounts, they may report and others they may not report. So you always have to be cognizant of this when you have a joint account because they may only report on the primary account holder. And one of the key items here that we're probably just going to harp on a lot with this particular presentation, and it's just very, very instrumental just to having a real good credit score. Pay your bills on time and in full. Never miss a payment. So here's a little scenario here, and I'm just going to briefly read through this. And this tells a story about two friends since middle school. Each of them has their own card and steady incomes to pay their bills. So it seems like they're doing pretty well. So friends from middle school, now they're off on their own, look like just, living in the city, trying to take care of their careers and be successful. On the opposite end, Anna has a credit score of 530. Now, remember earlier we had talked about just a minimum credit score of 579, and Anna is kind of below that number, while Bella's score is 700. And you can see 700 is considered really, really good. Well, anyway, Anna and Bella decide to buy homes in their childhood neighborhood. One of them receives a loan without any trouble, so we can kind of figure out who this is. And unfortunately, the other has a difficult time getting a loan. Well, she's probably having a difficult time because her history, as we said before, a history, which is with the score, has indicated that she has not paid her obligations according to term and to the amount that's due. When she finally gets her loan, and this is very, very important, her interest rate and insurance premiums are higher than her friends. So let's just go back to our little chart here again, where we talked about, just the credit scoring. Why is it so important? Because number one, you can maybe get better terms. You can have an easier application. Or if you're in this area right here, the concern is that you may be questionable to repay your debt. And as a result of that, the lenders are concerned, and so they're going to attach a higher risk premium associated with your obligation. And that higher risk premium is going to be in the form of a higher interest rate. Okay, generally there are three main credit bureaus in the U.S., and I'm quite sure all of you are just kind of familiar with this. And generally, lenders will get their information from these three various bureaus: Experian, Equifax, and TransUnion. How's your credit score calculated? Now, this is always kind of tough to figure out how your score is calculated because they use a bunch of metrics here. And for me, I think they kind of give all of these somewhat of a weighted average. But the primary one is just the amounts owed, your payment history, how long of a credit history that you have, any new credit, and types of credit. And for me, I always think that, your mortgage, your car obligations are probably some of the two primarily ones because, once you set your budget, those are always, it seems like the first two ones that are coming out to your monthly income. So you're just trying to always be cognizant of those two and make sure you pay those. And so there may be some weight there. How much of a weight, it's hard for me to tell. Okay, remember our scenario earlier. So let's talk about this a little bit more. So Anna's house is in foreclosure. This is not good. So if our house is in foreclosure, that means that obviously she was having some payment difficulty, and as a result, she hasn't been able to, pay her obligation. She has taken some steps to improve her credit and now eligible for a loan. Anna wants to use the loan to try and stop the foreclosure process, but she has a problem. She needs someone to co-sign. So when you need someone to co-sign, the lender is just very concerned. So the lender has done some due diligence and has come up with the observation that maybe your cash flow, your credit history is not strong enough. And so they want some more assurance the obligation is going to be repaid. And so they're going to ask for a cosigner. Now, keep in mind, when they do ask for a cosigner, that cosigner also may be scrutiny to a credit check. They're looking at their income. So they may also just want to verify some items just to make sure that person also will be able to handle that obligation, because essentially that's what a cosigner is. Cosigner is someone who's saying, hey, if they can't pay it, I'm going to need to guarantee this debt or I'm going to pay it myself. So I guess the primary question comes up, should her best friend Bella cosign on a loan with Anna? I don't know if there's any responses, yes or no, in the chat box, but can I just see one answer? Okay. I would say no as well, neither, because if a person cosigns, that means that, they may have to assume that obligation or they may be contingent for it. And so that's a very big obligation. So you really have to understand what you're doing. And how will co-signing affect Bella's credit? Remember, Bella's credit is pretty good. So if Anna doesn't, this could also affect her credit as having some more debt on her obligation. And also if payments are slow, this could affect her credit and drive her score down. Okay, continuing on. Michael and Tamika are getting married in 2 weeks. They are thinking about merging their financing by opening a joint account and applying for a joint credit card. So here's another scenario where two people are getting married and they're thinking about just having a joint checking account and applying for joint credit. Again, this scenario kind of similar to the one that we talked about briefly. Tamika has a good credit score, but Michael does not. Should they sign up for joint credit? Any responses in the chat? This one may be kind of difficult since they're getting married and they're thinking about just commingling their accounts and applying for things on a joint basis. So I can understand if some say yes and no on this one. Let's move on. What is your credit report? Your credit report is a snapshot in time. So really what the lenders will do, you will sign off on some type of credit authorization allowing them to obtain a credit report on you. And once they pull that credit report, it'll be dated, have your name, contact information, and it'll just give them a snapshot of how well you have paid your obligations, whether you're current, delinquent, and also most importantly, your credit score. And again, as we said, this will really help us understand how well you've repaid a loan in the past, and also your propensity to repay a loan in the future, because your past kind of tells us how well, how you've handled your obligations in the past. Well, it's a good indication of how you're going to handle your obligations in the future. Getting your free credit report annually. Now, if you apply for credit and you're denied, and or you've had, if you had some fraud on your account, or you need to apply for some type of government assistance, generally you can get a free annual report, and you can just go to the annualcreditreport.com, or you can call a number. Once you go to the .com, the annualcreditreport.com, you can just go in and put your information there, fill it out, and you can get your, and they'll either mail you or PDF you or email you a copy of your credit report. Now, this report may not have, and probably does not have your credit score on that. Generally, you have to pay a fee for that. And you can get a credit report generally from the 3 bureaus, TransUnion, Equifax, and Experian. And again, they will charge a fee on some cases if you need your credit score. Well, how does your credit report look? What's on your credit report and what does it entail? Generally, the first thing I always look for when I look at my credit report, I just want to verify accuracy. And there's a lot of common names, or our names are similar to somebody else. And so you want to make sure that your name, your information, your address, and sometimes they may even have your age on there. They're probably going to just black out your social security number and just maybe have the last four, something to that effect. But you just want to verify and make sure that all the information there is you. So that's the first thing that you want to do when you start reading your credit report. Then after that, you start looking through it, and then you'll see your current accounts, what's the status, what's open, what's closed. And you also, again, you want to make sure all of those are just accurate, they're a good reflection, and there's no misinformation there. Then after that, you may see the public records, if there are any lawsuits, bankruptcies, judgments, delinquent or unpaid taxes. Again, also verifying information. And the last component of your credit report is generally the who's been inquiring about credit on you. So that's and sometimes maybe your insurance company, or you may have a credit card with MasterCard, Visa, American Express, or whoever. And part of their agreement, they may say that we're going to obtain a credit report on you on an annual basis. And so you may see them pulling a report on you on an annual basis just to verify that things are going well. And in some cases, they may verify and just look at it, and they can just gauge. And let's just say, remember we talked about, we discussed a little simple scenario, maybe you having just an open line of credit with Dillard's. And so hypothetically, let's just say you have an account with Dillard's, and Dillard's may just pull an annual credit report. And so they do this on an annual basis, and they look at it and they say, you know what, things are going well. And with things going so well, we're going to increase your line from $1,000 to $2,000. Now, in some cases, they may not adjust it if they see things may not be going well, but they just may be monitored on their own. But just keep in mind, sometimes you may get a phone call from a lender or somebody, and they may offer you a line of credit or something. because maybe they just looked at something and they saw that, your credit is going well, and they may just offer you just just more additional credit. As we talked about, important dates to review on your credit report. Date your credit report was opened, dates of delinquencies, dates of public records, and dates of credit requests. And so you just want to, again, you want to go through and just make sure that the information is accurate, it reflects your history, and that it tells the story. So what do you do if, there's some issues? Well, there's the Credit Report Authorizations Act, and the Credit Repair Authorization Act was established to protect your rights as a consumer. So people are always concerned about the consumer and their rights, just to make sure that everybody's engaging in fair practice, and that what's accurately. Make sure that information is accurately reported, and that the consumer is not taking advantage of. What are some of the steps to repair your credit? Well, obviously, number one is, as we talked about, just to make sure that all of your obligations are paid on time. And if not, if you do have to contact the lender to request extended terms, or if you have an issue, try and do such, because that may help them or stop them from reporting negative information on your report. Now, just keep in mind, with COVID last year, some financial institutions offered some type of forbearance or deferral payment. And what that was, it's just that they offered their clients maybe a 30-day, 60-day, or 90-day payment deferral. And sometimes on their automobiles or their mortgages. And so what that means is that you did not have to pay during that time frame that they offered you a forbearance or deferral period. And during that time, if you did not pay, they agreed that, number one, they would not report it to the credit bureaus, they would not foreclose, and they may offer you some type of extended terms. And so it would not reflect negatively on your credit. So that was some of the things that was going on with respect to COVID this particular year, and also in 2020. Step number two, very importantly, if there is something negative there, inform the bureau, credit bureaus, and companies that provided information to the bureaus to report errors on your credit report. So let's just talk about, we had talked about the scenario earlier, maybe you having an open line of credit, a credit card with Dillard's. Well, you paid all your obligations and it's at zero, and it's been zero for a while, and they're still showing you as delinquent. There's some errors there. So you may want to contact that particular obligor, and I'm just throwing that name out, not trying to pick on Dillard's or anything, but just, you may want to just contact them and just let them know, hey, here's my records, I've paid everything and I'm at zero, but I'm still getting my credit bureau report and it's showing that I'm delinquent. And so they may have to correct that for you on your behalf. One of the things that you do when you do correct information, and it's very important just to document this information accordingly. A copy of your credit report, list of items that are being disputed, clearly state your reasons for the dispute, and copies, not originals, of documents that support your request for correction. And they also recommend that you send this information certified mail and request a return receipt. Doing such, what you're doing is just kind of help documenting your file and making sure that these issues are addressed accordingly, again, because the credit bureaus, they are obligated to respond back to you. Again, they are obligated to respond back to you within 30 days. What are some of the special circumstances as far as just monitoring and repairing your credit? Number one, again, monitor your credit report and score. pay your bills on time. And again, as I said, that's going to be a common theme, is just to make sure you pay and handle your obligations accordingly. Get credit counseling, and consider other financial products. What are other financial products? Other financial products may be, maybe you get a deferral, or you get some type of forbearance, or you get you work on some other type of arrangement with the lender. Some other type of maybe payment terms or something to that effect. Credit scams. What are some of the credit repair scams? Here we're talking about Anna again. Remember earlier we talked about the house going into foreclosure. So after her house falls into foreclosure, Anna researches several credit repair companies. Now, before I get into this, I do want to point out that generally before your house goes into foreclosure, the lender is going to try and work with you, maybe try and work with you maybe to restructure some terms, or try and help you out in the process, because I think that's probably one of the last steps that they want to do is foreclose. And so now we're jumping, maybe they work with her and they come to any type of settlement or arrangement. And so now the property is in foreclosure. With that said, one of the first companies that they promised to remove all of the bad credit information from Anna's report. All she has to do is pay an upfront fee. Of course, Anna is worried about her bad debts, but the company assures her that it can scrub all negative information from her report. The company also advises Anna not to contact the credit bureaus directly, since doing so would negatively affect the company's efforts. Again, the company advises Anna not to contact the credit bureaus directly, since doing so would negatively affect the company's efforts. So just reading through all of that, those 3 or 4 sentences there, and everything there, how many red flags did you catch in this scenario? Or is there any items of concern? Anything in the checkbox? Is this do you have some concerns, yes or no, about somebody that's offering to do all of this for you? I would say yes, because I think you always just have to be cognizant of somebody that's just going to just say, hey, you got to pay an upfront fee for something. They're going to repair everything, and they're going to scrub all negative information. And also just a promise to alter legitimate information. A warning not to contact your credit bureaus directly. You're entitled to dispute errors for free. It's your legal right. So just be cognizant and aware of that. And for me, just somebody just full disclosure. If they're, they should be upfront with you, tell you what they're going to do and what they can't do. And if they're over-promising and something seems that it's not right, generally it's not right. Other signs of a credit repair scam, asking for a signature on a blank paperwork. Oh, that's not good. Credit profile number scams, just, altering the numbers or anything they do there, that's just really a red flag. And a fake Social Security number scam. So just be aware of some of those things. It's just just credit card scams. Credit counseling services. We're going to highlight 2 here. National Foundation for Credit Counseling, NFC.org, Financial Coaching Association of America, FCAA.org. So these are 2 sources that can help you as far as just counseling, helping you repair your credit, and as far as just, trying to get you on the right track. Strategies to improve your credit. Well, as we said, the number 1 strategy, obviously, for me, is just always just to do not just over leverage yourself. Just kind of live within your means and making sure that you're able to pay your bills on time. Generally, as a rule of thumb, Lenders want to just try and make sure that you use less than 30% of your available credit. Now, remember, we talked about that scenario earlier with maybe you having a $1,000 credit limit. Well, if you're always maxed out on that, if you're using $900 or $1,000 and it doesn't pay down, that's a red flag that just may tell the lenders that you don't have enough capacity to pay it down. And generally what they would like to see is that you use 30% of your available credit. So 30% in this particular case, if you have $1,000, they want to make sure you're around that $300 range and making sure that you're revolving that, paying it down. So what I mean is that it goes up, it goes down, it may go down to zero, but you're staying around that 300 range. And so that means that you do have some capacity and things are going well for you. Do not max out on your credit cards. Pay your bills on time. Pay off your credit cards each month in full if possible. For me, that's always a plus because number one, with that, it improves your credit. And number two, you save on interest expense. Now, these credit cards, a lot of these credit cards, they may come with a higher, especially for consumers, they may come with an interest rate that's maybe about 18% per annum, which is probably about 1.25% per month. And so if you don't pay that, all you're doing is just you're adding additional interest on top of the debt that you are already owe. So that's really not good. So it's always good if you can to pay off your credit card balance each month in full because that saves you the interest expense. Pay off your loans on time. Do not apply for multiple loans and credit cards at the same time. Make a financial plan and debt management plan to reduce your debt. Again, that's just making sure that you kind of just live within your means and that you have the available income to support your obligation. Create and follow a monthly budget and review your credit reports for accuracy. Again, number one, really pay your bills on time and just don't over leverage yourself. Delinquencies, charge-off, collection accounts, and also just make sure you try to resolve those and take care of those. Not mentioned here, but just equally important. And again, that's delinquencies, charge-offs, collection items. Make sure you try and take care and address those because that will improve your credit over time. I try not to go through too fast on this, but just to make sure that we did address things that are important as far as your credit score. And remember, we talked about the various ranges. The range on the low end, 579, on the high end, anything above 800. And so what have we learned? It's important to review your credit reports regularly. You can request them for free, annualcreditreport.com. Your credit score is a reflection of your debt management. Again, this tells the lenders how well you handle your obligations. And how well you've handled your obligations in the past is a good indication of how well you will handle your obligations in the future. And again, you should always pay your bills on time and should not default on loans. Again, this helps get you a good interest rate, helps you get you good terms. Let's just say you're buying an automobile and, the dealership is offering you 5%. Well, with good credit, maybe you can go somewhere and they can offer you 3%. And also, maybe you don't want to pay it off in 48 months. You want 60 months. They may be okay to that just based on your credit history and how well you paid your obligations. But if your credit score is high, they're going to say, no, instead of 5%, we want to charge you 10%. And also, we want this repaid in 3 years, not 4. So just be cognizant of that and keep that in mind, especially when you're out shopping for, most importantly, a new home or refinancing your home or an automobile. Lastly, it is possible to repair bad credit by managing debt and credit responsibly. I think that's it. I kind of touched base on everything. And again, just most importantly, if I can just go back to probably the second or third or fourth slide here, just showing this range right here. And again, this is very, very important. You just want to make sure, if you can, just to be somewhere 670, 700 or better, because that tells people that, hey, I've handled my obligations, I've paid everyone. Your 740, 790, 799 is very good. And again, anything above 800 is exceptional. Now, it may take some time to get up to this, and I can't honestly say how long it takes, but generally they like to see a trend of you handling your obligations. And with that, I'm going to go ahead and open it up for questions.
And thank you so much. That was a wonderful presentation. We have learned a lot so far tonight. We want to hear from you. Alexandra, we already see a question in from you. Thank you so much. We'll get to that. And to all of our attendees, whatever questions you have about credit, send them in tonight. We still have a few minutes here, so we will promise to get through as many as we can. Our first question from Alexandra is, when you check your own credit score, does that count as an inquiry on your credit?
No, it does not. As we indicated, you're allowed, and I would encourage everyone annually, at least annually, it's just a good, just like you may do your annual checkup, health checkup. Well, this is just an annual financial credit checkup. And so you just want to pull your report on an annual basis, and just to make sure everything is accurate, everything is reflected accordingly. And as I said, there are a lot of common names. And sometimes information just gets reported, but it's incumbent on you just to really go through that and to verify everything, because nobody's doing it for you. So on an annual basis, you should always go ahead and get a copy of your report, and that is not a reflection, that is not an inquiry on your behalf. So no.
Thanks so much, Trent. And I would just add to that too, reminder, so many of us do mobile banking these days. So many of our banking apps have FICO score tracking built in at no cost to us. And so generally these types of inquiries, Alexandra, to your question, are called soft inquiries, meaning they are not pulling as much data as a hard pull. And so therefore they're not negatively impacting your score. If you're coming through the Dallas Habitat Counseling Program, you might have heard us talk about soft inquiries. That's what we do in our counseling program. So we're able to pull in your credit data, see your credit history, see your scores from all three bureaus, but it's not hitting as a hard inquiry because you're not applying for credit at that point. In that example, if you were to go on in the Habitat program to actually seek homeownership with Habitat and apply for a mortgage loan with our mortgage company, at that point, our mortgage company would do what's called a hard inquiry, which would impact your credit score. And again, hard inquiries for credit aren't impacting your score tremendously. That we're only talking about 10% of your overall credit score, but they can influence it, especially as Trent mentioned, if you're in between those ranges that are up on the screen right now, or if you're close to the end or beginning of one of those ranges, it can bump you into a different tier. So you want to be cautious about that, and really only get your credit score pulled with a hard pull when you absolutely need to. Let's see. Our next question is from, Lizette. We'll take your question real quick. The question is, should I be making my minimum payments to a credit card, or should I be paying the credit cards off by a percentage?
Well, if you make your minimum payment, that's always good. And so, but just keep in mind that when you do pay it off, in the long run, you save on your interest expense. And so that's a saving to you. Obviously, the credit card company, they may not want you to pay it off, and they just want you to pay the minimum so they can charge you the interest on the remaining balance. And so you should be leery of that. I would always encourage you just to try and pay it off in full every month. And that way you will save on interest expense. And also it shows how well you're handling your obligations. And so in the long run, it will improve your credit score, and you will save on interest expense. And in the short run, that's less cash that you may have because you're handling your obligations. But still, it is a good reflection of how well you pay your bills.
Yeah, these are great questions. I would say keep them coming. Any questions you have, send them in and let us get to them. And Alexander, I see your follow-up note on that about the 30% usage, right? And so to Trent's point, by and large, if you can make your payment in full every month, that is going to be the best way to do it, the best way. But if you can't, for whatever reason, then making sure that that balance is at or below 30% of your credit limit is a really good rule of thumb. Just to make sure, again, you're not overextending yourself between billing cycles. Our next question is from Akua, who asks, is there any advantage to opening joint accounts on credit?
I would say yes. The advantage is number one, you get a cosigner, somebody that's just going to help you out or use their name to show that that the debt is going to be repaid accordingly. And what you can do with that, since somebody is co-signing, you can just take advantage of that, making sure that whatever debt that you're extended, make sure you pay it on time and that you handle the obligation so that you can improve that on your, on your own. I remember years and years ago when I purchased my first car, and you remember that you're just coming out of high school or college and you're trying to establish credit. You didn't have, and I didn't have anything, and I had to get my parents to co-sign. Well, my parents co-signed, but I ended up paying for the auto obligation in 3 years. And so after that, I kind of established credit on my own, and I didn't have to have someone co-sign on the loan for me. So on the first time that I got credit, maybe the interest rate was a little bit higher, but since I had a co-signer, it came down a little bit, and I was able to pay off that obligation. And so I kind of improved my situation by having a co-signer. And that also allowed me to get what I wanted, which was a car.
Yeah, and I think that's absolutely a great point too, Trent. There's, always going to be circumstances, I think, that, it makes sense, especially within a family unit. It makes sense to open a joint account, whether it's an authorized user on a credit card, which, gives someone more limited rights, or whether you're actually co-signing for that credit. But back to our earlier discussion, we always want to be cautious. Who are we co-signing for, and how confident are we? How sure are we that those payments are going to be made in full and on time every single month? So, just use your best judgment on that. Make sure you know and trust whoever you're opening that account in your name with. And if, of course, if that's a parent-child relationship, a lot of times it's a lot easier to manage. Alicia,
again, yes, you want to just be very, very cognizant of that, because sometimes if you're co-signing, that means if that person cannot handle that particular obligation, the lender may, the lender is assuming that, hey, if they can't pay it, you will. And then if you can't pay it, well, that could, reflect badly on your credit as well too. So as Blaine indicated, you have to just be cognizant of that, who you're signing for, making sure that that person can handle that particular obligation, and just do not over leverage yourself with another contingency.
That's so important too. And the last thing I'll just say on that topic, we get this question a lot at Habitat when we're reviewing credit, a lot of times with our clients, and there may be a car payment or a credit card or personal loan that's taken out in our client's name, or partially in our client's name, is on their credit, but they took it out in their name for somebody else, for a loved one, for a friend. And oftentimes we hear our clients say, well, that's not mine. That's a credit card on there, it's in my name, but it's not mine. And we always give, some gentle pushback. And, all of you who are on tonight that are in our program can attest to this, right? We'll say, well, if it's in your name, it is yours. Because to Trent's point, if that person does default or doesn't make that payment, that creditor is coming to you and they're looking for payment. So hopefully is the case that they, whoever you co-sign for is making that payment and it's not a big deal. But even if they are making payment, another thing to be cautious of, hopefully if you are co-signing, it's not for anything hugely impactful. But, when we co-sign for something like a car note, for instance, like an auto loan, That also, even if that car note is in good standing, sometimes that can also impact our ability to get qualified for a mortgage, right? Because as we'll learn in some of our homeownership classes that delve more into the specifics of getting qualified for a home loan, one of the things that mortgage lenders look at is our debt to income ratio. So even if you co-signed, let's say for a sibling, and you co-signed for a car and they're making that payment on time and in full every month, and it's in good standing, that debt, if it's in our name as well, is being factored into our debt to income ratio. And sometimes that can affect our purchase power when it comes to home ownership. So lots of reasons to just really think about not just where you are financially today, but where you want to be over the course of that loan. And if you think co-signing will negatively impact you from being able to attain your own financial goals as well. Okay, our next question is from Shamir, who asks, is it better to request a higher credit limit from the credit card company, or would it be better to apply for another credit card, which will increase your credit score or hurt your credit score?
Well, let me see if I can answer this one. I may need some help on this one too. I always say, again, number one, you kind of hit on this with just talking about your debt to income ratios. Lenders look at that, and I think they want to be somewhere less than around 40%. And also, just with your open lines of credit, rule of thumb, they want to use theirs less than 30%. So let's just say, you know what, lenders, I make $1,000 a year, and this lender is offering me, and I'm just hypothetically, a lender is offering me a credit card for $3,000 a year. Now, again, I only make $1,000 a year. So just because they're offering that to me and I may be able to get it doesn't mean that it's good for me. Because what if I just max out on that and my income is only $1,000? I won't be able to repay it. So I know that I'm going to have problems there. So again, I'm always cautious about what's being offered and how much I can handle. And you probably know your situation better than anybody else. And so just keep that in mind. So, all of a sudden, hey, you know what? They've offered me a credit card for $3,000. My income is $1,000. I've maxed that out and I want to buy a house. Well, the lender's going to look and says, you know what? You're over leveraged. Your debt to income ratios are just too high. I don't see how you're going to be able to repay this. So you've gotten yourself in a situation that you cannot handle your obligations. So for me, I probably would say no. I just want to make sure that I handle, um, my budget, and that I'm able, whatever I sign up for, if I do max it out, I'm able to repay it.
Yeah, I think it's a great point, Trent. And I think, and I see another kind of a follow-up question coming through about, but what about, does it increasing my capacity show that I can handle more? And if you indeed, to Trent's point, I think if you know yourself better than anyone, right? So if you know, like, I'll give an example on this. And Trent mentioned kind of, in personal experience, being younger, opening our first lines of credit. Many of us open our first credit cards when we were younger, right? Maybe out of high school or out of college. And those credit limits may not be very high, right? Because we didn't have a lot of credit. And so the bank didn't fully trust that we could manage that credit card, right? So they took a baby step probably and gave us a small credit limit. And as we begin to establish credit history, if we are doing things like making our payments on time and in full every month, and we know that now our financial obligations and our financial goals are bigger than they were when we were, 18, 19, 20, then there's no harm necessarily, to Trent's point about, if your credit card company comes to you to increase that limit, or if you're seeking out a limit to bump that limit up. But of course, again, the idea here is to be very mindful of how much you're bumping that up, because remember, whatever that credit limit is, you technically can borrow up to that limit on that credit card. So the question is really from a financial discipline perspective for us to ask ourselves is, can I trust that if I max this credit card out, I can pay it? That I can pay it and it's not going to get me into a cycle of debt that I can't dig out of. So that's a personal question, you want to ask yourself. And I think, Shamir, to your question about, which of those options would increase or hurt your credit score. Whether you're applying for a credit limit increase with your existing credit card or with a new credit card provider, both are generally going to do a hard inquiry because you're applying for additional credit. So either way, you'll take a slight dip in your credit score, probably, a couple of points, not a huge deal. But yeah, it'll have an impact for sure.
Hey, along with that, you mentioned one thing there, and I just want to harp on that again. And, with discipline becomes discretion. And discretion is just really, as we indicated, making sure that you can just pay your bills. Discipline is making sure that you just do not take on too much. Now, with a credit card is a line of credit. So you get a line of credit, and like we said, that a number $1,000. That is supposed to really, it goes up, it goes down. And if you buy an automobile, that's what they call a term loan, and that pays off in 4 years. And so, really, you want to have some discipline with your credit cards, meaning that you do not put obligations on there that should be paid off in a short period of time. You don't want a car loan on your credit card because you can't pay a car loan off every month. So you want to make sure that you match whatever you put on your credit card with its economic life. And that should be something that is short term. And with an automobile, again, that's 4 years, 5 years, 6 years. With your mortgage, that's 30 years. So you have to be careful how you, again, the discipline, discretion, how you handle those obligations.
That's a great point, Trent. And one thing I'll touch on too here related to credit cards. We didn't get it too into detail of this tonight, but I'll share with the group. One tool that we often coach our clients through here at Habitat in terms of healthy ways to build credit is what's called a secured credit card. And if you haven't heard of the secured credit card, or you're not sure if that's a good option for you, and if you're working with a counselor here at Habitat, make sure that you reach out to Aretha or Porphyria about this, and they can help walk you through whether that would be beneficial based on your financial profile. But in the case of a secured credit card, you would put down your own collateral, one of those 5 C's of credit that Trent talked about at the beginning, right? So you'd put down a deposit, and then at your credit card limit matches the amount of the deposit that you put down. And I see Lentoria shot us a note in here that she has one. Awesome, Lentoria, that's a great tool. So I'm gonna say you're well on your way to building credit, if you're just starting out. But it's a really great way to make sure, again, that you're not overextending yourself. If you put down $500 on a secured credit card, your limit on that card is $500. And so in that way, that you're able to make that payment. And, we always give this example when we're using credit cards specifically as a tool to build credit, to make sure that we are keeping those payments below 30% of our limit and within reason. Think about, to Trent's point, putting small financial obligations on that card that are not going to take a long time for you to pay off. So maybe, your grocery bill, maybe gas, maybe small bills that you owe. Things that are very reasonable versus, racking it up on something and then saying, oh my gosh, that was easy to swipe, but I don't know how I'm going to make this payment at the end of the month. And Lentoria says in the chat box, she only uses hers once a month for gas, which is great, right? So she's charging them up for gas. It's feasible enough that at the end of the month, the bill comes, she pays it off in full. And so just after a short amount of time, normally we're seeing in homeownership counseling after 3, 4, 5 months of consecutive on-time in full payments, we're seeing that credit score go up. So, it can be a quicker process than you think if you're working through these credit tools strategically.
Another good thing with that, Blaine, along with that, is that there's sometimes advantages to having a credit card. I have a Visa MasterCard, and I've had this, I don't know for how many years, 15 years. I've never paid for an airline ticket because I would always get the points, and I would use that for my travel. So one of the, just the perks of having that, paying it off and using it wisely, is just that I was just afforded, just the the airline mileage. So, sometimes you can get credit to work for you in terms of just not only a good credit score, but there may be some other perks as well too that you'll find very beneficial.
Love that. And that's a good, reason too, back to Shamir's earlier question about, if I already have a credit card, does it make sense to just bump my limit up or should I look at another card? And Shamir, that's another benefit, right? Is that after we build positive credit history and we're in these ranges that we see on the screen right now of like 740 plus, we're in that very good or even that exceptional range. We've demonstrated to the credit card companies, to the bureaus, and to ourselves that we can manage our finances on a credit card, and that we are responsible and we're not going to overextend ourselves. And so then you may think about, are there cards out there, like Trent mentioned, that would give me some, points on things where I can save some money because I've already established that discipline, that financial discipline that we've been talking about, to make sure that when that bill comes, it's paid in full.
Right. And at the end of the day, I think most importantly is, home ownership eventually, as you talk about, when we go buy that house, we want to just make sure that we have a real good low interest rate. And because that'll help improve, just help with your monthly payment. And also, when you have a low credit score, that means more of what you pay is going to amortize principal rather than interest. And so, the higher the credit is, the interest rate, well, you're going to have just a little bit more of your payment amount going toward interest and less toward principal. So, that's part of that discipline again there too, just that you can handle that obligation and, pay little as less in interest.
Yeah, and that is a really important topic to be talking about right now, right? Interest rates are so competitive still. This is still a great time to get qualified for a mortgage right now if you're financially ready for that. But even 0.25% on a mortgage interest rate can make a huge difference in terms of how much money you'll end up paying or saving over the life of your loan, typically a 30-year loan if we're talking about a mortgage. So super important. Trent, I want to thank you so much for being here tonight and for answering all of our questions and sharing your knowledge and expertise. Thank you so much.
Oh, thank you guys for just letting me be a part of this. And, I'm always available if I need to follow up or if there's any other questions.
Love it. Thank you so much. To our attendees, just a few closing remarks before you guys hop off the call tonight. Alexandra, I see your question about, she said unrelated, but what does it mean when people keep saying it's a buyer's market? Right now, we would say it is not a buyer's market. It is a seller's market, big time, which means right now, we're facing an inventory shortage when it comes to housing, not just here in DFW, but really nationwide. And that is causing prices to go up. And so as those prices go up, it's becoming, hard, challenging for buyers, especially first-time buyers, to be able to competitively put in offers that are going to get accepted on homes. And so what I would say to you, Alexandra, and to all of our attendees here tonight, on that topic, you definitely do not want to miss our next class that we have next month, which is the Intro to Homeownership class. We're going to bring our partners on at Bank of America to talk about preparing for homeownership and getting yourself pre-qualified. Not just that, but what I love about this class, Bank of America also has amazing products for first-time home buyers, grants and down payment assistance. And so these things can really help you become a more competitive buyer in the marketplace. So make sure that you register for that session. It's on our website, just like where you went on to register tonight. You can find that on our webinar calendar as well for next month. And I also want to drop in one more resource into the chat box real quick. And that is, if you're not familiar, Dallas Habitat has an awesome resource called PocketWise. And PocketWise, if you haven't checked it out, definitely be sure to check it out. This is self-guided financial education that you can take on your own time. But on PocketWise, we have a ton of modules that teach you about some of the nitty-gritty specifics of topics like credit. So a lot of what we delved into tonight, but on a much more detailed level. And so really breaking down specifically how an interest rate works, how APR works, we'll dive, very much into detail about credit cards specifically. And so if you haven't checked that resource out, make sure that you do it. We track all of your class attendance, whether it's on PocketWise or in webinars like we're on tonight. You get credit for everything you do in our program. If you are educating yourself, we're going to give you props for that. So to all of our attendees who are here tonight, thank you guys for making time over the last hour to join us. We hope that we've found it helpful and have learned something. And make sure to, last thing I'll say, we have a class as well this weekend. We have a home buyer education class. And I think some of the names I see on here, I think some of y'all are registered for that class. If you're not sure if you should be in that class, send a note to Aretha or Porfirio. They'll let you know. But we'd love to see you if you can make it. It'll be an awesome class. Friend, thanks again. We hope to have you back in the future. And y'all take care. Have an excellent night.